Now, we would like to invite you to our more technical discussions with our distinguished tax expert, Ms. Thi Kieu Nga, who is the head of corporate tax in Hanoi office. She will sort of sharing with you about the development of tax policy. For example, some of the tax incentive for R&D and large-scale projects, CIT reductions for small and medium-sized businesses, and e-invoice implementations. Now over to you, Chi Nga.
Thank you, Tam. Ladies and gentlemen, as you can hear from Warwick's presentation, you see the microeconomics and also the tax landscape. So let's see how those factors will impact the development of the tax policies. In particular, it is the tax policies in the new normal, and also some of our key observations of the law on tax administration. And next, we will be sharing with you on our practical information or insights, the matters focused by the tax authorities, and some interpretations of the tax authorities in regard to some important tax law and regulations in Vietnam, which will cover corporate income tax, value-added tax, and foreign contractor tax. So let's move on to the details of the development of the tax policies and law on tax administration. So in the development of the tax policies, I will be sharing with you on the 4 key areas which we think that very important and significant to your business as well as your business plan. The first one will be the new law on tax administration, new law on investment, which is effective from next year, January 2021, which introduced for the first time a special incentive package for the R&D and large-scale projects to attract investments. The second one will be the relaxation of the cap rule for the interest expenses. And the third one will be the 30% reductions of corporate income tax for small and medium enterprises in response to the pandemic impact. And the last one will be the e-invoice implementation, which is postponed from 1st November 2020 to 1st July 2022. Now, let's move on to the details of the tax policies development by having take a look of the law on investment, which is effective from next year, 2021. And for the first time, the government introduced a special incentive package under the new law. As you are aware that the existing law allows a maximum incentive package is 4 years tax holiday, 9 years tax reductions, and 10% for 15 years. But in this new law, the government introduced a special incentive package, which is up to 6 years of tax holiday, 13 years of tax reduction, and the tax rate which will be reduced from 10 to 5%. And the period for applying this 5% is up to 22.5 years. And subject to the negotiations with the investor, the government is willing to further grant an extension of that period for another 15 years. So what are the projects entitled to those incentives? Those are R&D centers with the total investment capital of approximately $130 million US, and those investment in special encouraged sectors with the amount of approximately $1.3 billion US. So what do we see from this new law on investment? It shows that the Vietnamese government is willing to accept and negotiate a special incentive package in an effort to attract more and more high quality projects. And it is implementations of the Politburo resolutions number 50, whereby the Vietnamese government is required to develop a special incentive package to put Vietnam in a stronger competitive positions to attract high quality projects. So we expect that in the coming time, there will be more and more quality investment projects inbound into Vietnam. The second one, which we think is worth to highlight here, is the relaxations of the interest expense cap rule from 20 to 30% EBITDA, and which is applicable from the year 2019 and also retroactively applicable from the year 2017. And it is important to note that it is now confirmed in the new decree that the interest expenses subject to cap is the net amount whereby you can offset against the interest income in order to determine the cap. And in this new decree, it also for the first time introduced the 5 years carry forward rule that apply from the year 2019 only. So this is I would say that this change is most welcome by many local and foreign taxpayers, whereby it has been for a couple of years they are lobbying for the change of the policies, because the cap rule 20% significantly impact the tax liabilities of those companies. The third one on the tax policy development is the 30% corporate income tax reduction for small and medium enterprises. And this is in response to the pandemic impact, because it is only applicable for the tax year 2020 and for small and medium enterprises with a revenue up to 200 billion VND only. And it is worth to note that it is also applied to the quarterly provisional corporate income tax payments, and those are entitled to corporate income tax incentive, and those have additional corporate income tax payment as a result of the tax audit is also entitled to apply this rule. The last one in terms of the tax policies development would be the e-invoice implementation, which now postponed to 1st July 2022, where the tax policies, the tax authorities are now ready in terms of the infrastructure and the invoice management for the implementation of e-invoicing system. So it is only compulsory from 1st July 2022 instead of November 2020. And from now to 30 June 2022, you can use either the paper invoice or the e-invoice under the existing regulation. And please note that if you use the decree, either Decree 51 or Decree 119 as the basics for the invoice issuance and management, you have to follow those respective decrees and is implementing circulars in terms of the point of time to issue invoices and the reporting and management system of that invoices. So I believe that you are aware of certain differences in terms of the invoice management between the two decrees. So that's my update on the key developments of the tax policies. I'm now moving on to the law on tax administration, which we think it is quite significantly impact the right of the tax authorities, the responsibilities and the rights of the taxpayers. And our key observations of this new law is higher penalty and stricter administration measures, both in an effort to reinforce the compliance with the tax law and regulations. And the third observations will be the increasing the digitalizations in tax administration, the use of e-invoicing system, the tax digitalizations in the digital world. And the fourth one will be the role and responsibilities of the commercial banks in support of the tax authorities to collect taxes from the taxpayers. And the fifth one is a very important notable changes in tax declarations and payment. And the last one, and I believe very important for the taxpayers, is whereby the law realized the equal right of the taxpayers towards the tax authorities, not one way from the tax authorities to the taxpayers. So it is important for the taxpayer to be aware and understand its rights against the tax authorities in terms of the way to deal with the tax authorities in the coming time. So I will move on to the details of the tax administration law. In higher tax penalties is one of the measures to reinforce the tax compliances. According to a submission paper from the MOF, Ministry of Finance, to the government, it was reported that over the last few years from 2014 to 2018, the number of violation cases has been increased 5 to 6 times, while the number of taxpayers or new enterprises only increased 1.5 times. So what do we say from this? This is because the current tax administration law, whereby the penalty and sanctions are not strong or heavy enough to reinforce the compliances. And that's why there was a proposal from the MOF to the government to increase the level of fines and penalties from 2 to 4 times of the existing level under this Decree 125. And the penalties are based on aggravating and mitigating factors. So in this new decree, it defines the aggravating factors is the large scale violations, such as the violations of a tax amount of from 100 million VND, or a value of good from 500 million VND, or a large amount of invoices from 10 or more. And interestingly, the late payment interest is not only charged on the tax under declared tax amount, but also on the delayed payment of fines at 0.05% a day. Another measures to reinforce the compliances is under the new decree, it introduced some stricter administration measures also for the first time in this new law. It realized the rights of the tax authorities to disclose the name or the information of the taxpayer on the mass media. So it is really a reputation impact for the taxpayer, is that if their name is posted on the mass media, in case they fail to provide the information to the taxpayer, or they fail to follow the tax decision made by the tax authorities. And another case whereby the tax authority has the right to deem an amount of tax in case the tax authority failed to comply with the tax audit decision. Or it also recognized the right of the customs authorities to impose or deem a tax amount in case of there is a negative difference in terms of the raw materials and supplies imported to process or produce export goods. The reason is because those materials are imported free of duty if it is imported for the purpose of manufacturing export goods. But the negative difference means that there is some raw materials and supply has been consumed domestically, and therefore the custom authority has the right to deem a duty and tax amount. Also, for the first time in this new law, there is a rule to prohibit the legal representative of a company to leave or exit Vietnam in case that company has not fulfilled its tax obligations. It is new to Vietnam, but it is not new to other jurisdictions, I believe. Also in this, another measures is whereby if you as an organization, you pay bonuses, sales support, marketing and promotion expenses, cash or non-cash basics to the individual, then you are liable to declare and pay tax and withhold it on behalf of the individual, not the individual themselves. So those are measures under the new law to reinforce the tax compliances. I would like to move on to another interesting topic on the tax digitalization in the digital world. So as you can see, the use of e-invoice, the use of electronic documents would have enhanced the transparency in the economic transaction and have to reduce the risk of fraud. And with the enhancement of technology, it helps the tax authority to integrate the information exchange among the taxpayers, the tax authorities and other competent authorities such as immigrations and police departments and etc. And also in this new law, for the first time, it introduced the special mechanism to tax the overseas e-commerce and digital-based businesses. Tax digitalization is not only a new issue for Vietnam, but also to the rest of the world, I believe. And let's see what are the tax mechanisms to tax those digital businesses. So in this new law, it requires that the overseas suppliers are required to register or authorize a third party to register to pay and declare tax through a portal developed by the General Department of Taxation. So it is all, digital, online declarations and payment, no paper filing. And if they are not registered, they will be subject to a withholding mechanism. So as you can see in the mass media at the moment, it is the intention of the policymaker to require a lot of giant technology or e-commerce businesses and all the big four names has been mentioned in the mass media with a real intention of requiring those making billions of dollars a year from doing business in Vietnam that requires them to pay a fair share of taxes to the Vietnam tax authorities. So let's see how the withholding mechanism will work in the new rule of the law on tax administration. So we move on to the role of the commercial bank here. So with this new rule, the commercial bank has two main roles in support of the tax authorities to collect taxes. The first one will be the withholding role, and the second one will be the role to collect the data and information and report to the tax authorities. So with the withholding role, what exactly the commercial bank are required to do? It is first, with the B2B businesses, it is very simple because there is a foreign contractor tax mechanism whereby the Vietnamese contracting party are required to withhold and declare with the tax authorities on behalf of the overseas vendor. But with the B2C businesses, it is the role of the commercial bank here to withhold and pay taxes to the tax authorities if the individual is making payment to the commercial bank. But with most of the e-commerce businesses, they are not making to the commercial bank. Most of the time, they make to the intermediaries like MasterCard, like Visa cards, like PayPal, and it is impossible for the bank to withhold. But if this is the case, then the bank are required to maintain the data and report on a monthly basis to the General Department of Taxation. So apart from the withholding role, the commercial bank are required to report to the tax authority upon request on the bank account details, the name and the account number, the opening date, the closing date, and also the account balances, the transactions date to the tax authorities. So the role of the commercial bank here are quite important in terms of supporting the tax authorities in collecting taxes from the taxpayers, either it is B2B or B2C businesses. Next, I would like to highlight the important changes in the tax declarations and payment, which we think that very important for you as a taxpayers to be aware of the significant changes in order to comply with the laws and regulations and be aware of the right in terms of tax optimization and for your organization. The first significant changes are the requirement to pay the provisional corporate income tax payment that for the first 3 quarters, it must not be less than 70% of the whole tax year corporate income tax liabilities, as opposed to 80% under the existing regulations. While the Decree 126 will be effective from 1st December 2020, so many of organizations are now having an important questions whether it is the new rule is applicable for the fiscal year ending 31st December 2020 or not. And if they underpay the tax liabilities for the first 3 quarters, is there any late payment interest will be imposed for the underpaid provisional corporate income tax liabilities under the new rule. So with the effective date of the new decree, 1st December 2020, it is not effective yet as of today. And based on our discussion with the General Department of Taxation, this new rule is not applicable for this fiscal year ending 31st December. You will be following the existing rule to pay the provisional corporate income tax liabilities. And this new rule is only applicable for the fiscal year ending after the effective date of the decree, which is after 5th December 2020 only. And we expect that the General Department of Taxation will issue a written guidance for the taxpayers to implement this rule. And next, I would like to highlight here, and we think it is a very significant and important change in the way of the tax filings and payment for dependent units or dependent accounting branches located in other provinces. In this new law, if you have dependent branches located in other provinces, you have a right to centralize your VAT filing at the headquarters if your accounting record is centralized at the headquarters, except for certain cases. So this is, to us, very significant, as you can see over the last decade, that many taxpayers are trying to centralize the VAT filing at the head office because they have too many branches, dependent branches in many provinces. But the approval on the centralized VAT filing is only on a case-by-case basis, and not many was approved by the tax authorities for this centralization. So this is a very positive change to enable the taxpayers to have an effective VAT filing plan in the coming time. And another important change in terms of the tax filing for dependent accounting branches in other provinces is those eligible for the CIT incentive will be required to determine separately its corporate income tax payable and declare directly with the provincial tax authorities where it is located. So it is really a significant change as compared to the existing rule whereby those dependent units are not required to determine its own CIT payable and declare directly with the local tax authorities where they are located. So those are all the significant change in terms of the tax filings and payment if you have many dependent accounting units in other provinces. And last, on the tax administration laws, and I believe that this is very important as the taxpayers, as the first one will be the interest on the overpaid tax and fines, and it is also for the first time in this new law, it recognized the right of the taxpayers to request the tax authorities to pay the late interest payment of 0.03% per day on the overpaid tax, late payment interest and fines. So it recognized the rights of the tax authorities in case their tax has been wrongly collected by the tax authorities. And the other important one is if you have a kind of administrative violations, but it is due to technical IT problem that has been reported in the web portal of the tax authorities, you will be exempt from penalty and late interest payment as well. And last but not least, it is also for the first time that it recognized the right of the tax authorities to be exempt from any penalty and late interest payment in case you follow the written instructions and decision of a competent tax authorities. Let's say if you have a tax audit minute that issued by the local tax authorities, and later on your case is reopened by a higher tax authority, GDT. And if you follow the previous decision issued by the tax authorities, and next time your case is reopened, you will be exempt from penalty and late interest payment if you follow the decision made by the local tax authorities. And I believe that Mr. Phuc from the General Department of Taxation will be sharing more insights on this point at a later section. Right, so this is what we are sharing our key observations of the new tax policies and the new law on tax administration. Now we will be sharing with you some practical experiences, insights and issues focused by the tax authorities in the recent tax audits, and also the interpretations of the tax authorities of some important tax rules and regulations. I will hand over to Mr. Ta Hong Thai, my fellow partner. He will be sharing with you on this. Over to you, Mr. Thai.
Now, Mr. Thai will continue the conversation set out by Ms. Nga, and he will share with you some of the practical sort of matters that you need to pay attention to during a tax audit. Over to you, Thai.
Thank you, Tâm. Thank you very much, Nga. Good morning, everyone. Again, thank you very much for joining our webinar today. I hope that you enjoy the first section of corporate tax about regulatory update presented by our colleague, Ms. Nga. So, following the program, I'm happy to share with you practical issues of tax that could be very important, and the companies may have problem to deal with. Maybe because the regulations are not clear, or the tax authorities may focus in the tax inspection process. So that will be helpful that you understand to manage. Before I go into details, I would like to emphasize that our presentation today is just to give you very general ideas about potential issue, potential challenge, or the way that the tax authorities might challenge you, so that you may have a general idea how to manage that. In the afternoon, our colleagues may talk more about some controversial issue. So if you have any question during my presentation of the tax practical issue, you should note it down and then send question to us. We'll discuss in the Q&A section. So let me move on to the first section of tax practical issue about corporate income tax. The first area I want to discuss with you is deductible expense for cost of materials. And the first issue is relating to the adjustment of cost of goods sold after stock take. What is the issue? Normally, you know that either the manufacturing business or trading business, whatever the costing methods, or when you done the stock take, you may charge fully to the cost of goods sold to increase the cost of goods sold. But tax authorities, they may look into this very carefully. The way they consider this is they treat that as a loss, maybe because of during the production stage, or warehousing stage, or transportation stage. So when they consider such a loss, they may say that there should be some people to be responsible for that. Or more aggressively, they may say that, the company may have sold that material to the local market without recognizing taxable revenues, or somebody have stolen the material. And then with that aggressive challenge, they may disallow the adjustment of cost of goods sold. For the next issue, which is damaged goods. For this damaged goods, either during the production stage or trading stage, the tax authorities, they may look at this very simply to challenge that the damaged goods do not contribute to the revenue generation stage, so they disallow the expense. The next issue is relating to the purchase cost of marketing and advertising materials. Because you know that in practice, people normally charge 100% the cost of purchase of marketing and promotional materials to the cost of goods sold during the period. But the problem for you is that if the materials have not been fully used by the end of period, or the sale program have not been finished, then it's very likely that a portion of the material cost should be allocated to the inventory. Tax authorities, they know this very well, and for consumer companies, consumer goods trading companies, this normally happen. Another issue relating to cost of material is relating to the adjustment by the custom authorities during the custom audit. You know that for manufacturing company, normally you have to finalize with the custom authority for the consumption of material. Adjustment may be made by the custom authority in the custom audit. Recently, tax authorities also refer to the custom audit, and then if the custom authority make adjustments, they may similarly make adjustment for corporate tax. The problem is, in most of the case, the judgment by the tax inspectors is unreasonable, because the issue for custom is different with issue in corporate tax. So in most cases, it may become a disputable and controversial issue and may lead to appeal later on. But if you do not have strong supporting document to prove or strong accounting record to prove and to convince or to present the movement of stock, and then you may have problem to explain to the tax auditors, and then you may end up that the minutes will indicate you have to pay additional tax in the audit. So that is some key issue relating to cost of materials. I would like to move on to another areas of employment cost. For employment cost, recently tax authorities they focus on the payment for expatriates. You know that there will be many types of payment for expats, but there's still many cases that in practice the companies still pay to expatriate staff based on the group policy or some policy of the parent companies. And then tax authorities normally challenge that, okay, the payment should have supported by the local policy. So in this case, it's easy for them to challenge, right? So it's a matter of localization of group policy to the local company, to the subsidiaries. But in many cases, for the short-term assignment of expat to Vietnam, the issue may still happen. So you need to be careful about this. The next issue is employment cost of expatriate staff for the period without work permit. This happened recently in practice that tax authorities challenge that for expatriate, when they have not obtained the work permit, the cost of employment is not deductible. Tax authorities in practice, they know very well that obtaining work permits is very consuming, but that still happen in practice. They still apply the treatment. And also that there's some ruling already issued by the local tax authority confirms this treatment. The legal base behind this is not clear under the current regulation, but during the tax audit, they just say that all kind of business expense, all kind of corporate tax expense must be in compliance with other laws. So for employment costs, that must be in compliance with labor laws for work permit. So for this, we need to take care of better for the work permit application. We would like to move on to another areas of corporate income tax deductible expense relating to related party transaction. Recently, this is a very key area that tax authority will focus on when they handle the tax inspection. The first item is very common in practice and very important also is the interfirm services. So in practice, local companies may have problem to keep supporting document for the interfirm services. And in a tax audit, tax authority normally focus on this and challenge evidence of service performance or supporting document to justify the cost base. At least they justify whether the expense, the service charge is relevant to business or not, or whether it's necessary. So it's quite troublesome if they challenge the supporting document that may be kept in the head office or the parent company. And if they challenge for the cost base, it's also very difficult because you have to work with overseas people to have a supporting explanation for the cost base. And this is not easy in practice. Another issue is relating to royalties. Recently, tax authorities, they focus very much on the charge of royalty. In our observation so far, that people may believe that the charge of royalties is quite safe in practice, right? But recently, tax authorities, they focus more on the actual application of royalty. For example, if you charge for patient, for the know-how, for the technology transfer, they may challenge the ownership of the royalty, whether the transferor actually have ownership or not, or they will look into detail how the company actually applies the technology, how the company actually applies the know-how into the production or business. So in many cases, in practice, the company fail to explain to the authorities because they don't have evidence that the know-how, the technology have been applied in their business, right? And some other issue, for example, for franchising, the challenge is very simple, that franchising agreement must be registered with the authorities. If you have not registered, definitely they will disallow the expand. Very simple. So this area is very hot at the moment, that in most of the tax audit case, the tax authority will look into this. We move on to another expenses. This year, there's been some concern about some kind of expense incurred by companies during the pandemic period. The first item of concern, very commonly a question, is about depreciation, because many companies, they have to put business on hold. The machinery and equipment we put aside, not used for production. So the question is whether the depreciation cost is deductible or not. And then recently, tax authority confirmed that yes, the depreciation expense during the period that the assets put aside can be deductible if the period the assets not been in use less than 9 months. So this is just consistent with the current law. The current guidance of the tax authorities has nothing beyond the law. So we may have a question: what if the assets is unused for more than 9 months? And in that case, the question is still not yet answered. And we may have to refer to other cases. But in that case, the deductible expense only apply to assets put aside for repair only, not for the reason of pandemic issue. So another kind of expense incurred during the pandemic period is some expense relating to staff during the quarantine period. You know that local staff or expatriate staff this year, they may have been subject to a quarantine period, and the company may spend some kind of expense for them. So the question is whether this expense is deductible or not. When talking to the authority, in practice, they confirm that the expense should be deductible. But in principle, the expense should be proved by the company that is relevant to business. And of course, the way that we prove the expense is relevant is when the staff and the expat they are the employee of the company. But I still have a concern that with the current practice, when they still challenge some issue like work permit for expat, whether there's any potential issue during the tax audit later on. Because similar to the work permit issue, right? When the expat has been subject to quarantine period, either in Vietnam or overseas, and then obtaining the evidence could be a problem. And then for the new expat coming to Vietnam, they may also have the same issue of work permit. So in that case, what will be the final treatment of the authority to support the company during the pandemic period? We don't know. So if you have this, in principle, you should charge to the deductible expense, but you need to be well prepared for the supporting document to explain to the authority later on in a tax audit. Another type of expense is the advertising and promotion expense paid to indirect customer. So in practice, especially for distribution company, when you make payment of advertising and promotion expense to some sub-agent or sub-distributor, when you don't have a contractual relationship with them, tax authorities, they normally challenge that, okay, you don't have a selling relationship with them, so why you pay to them? And they demand that the payment should be made by the main distributors or the first tier agent, sales agent. So in this case, even the law is not clear about this. So tax authorities, they just apply the concept of relevance, whether the expense is relevant. But the way they apply the relevant concept is very aggressive in this case, because in most of the case, the sub-agent or the sub-distributor still selling the products of the company. The only problem here is that they don't have a direct contract with them, with the company. So in practice, people try to connect two contracts together, or they try to sign three-party contract or four-party contract. That is a good way, at least, to explain to them, to the tax authority later on, that we have a contractual relationship, but that is still not 100% guarantee in the practice. So in this case, you need to consider with consultants or consultant for this if the issue is significant. Another issue I want to share with you is the expense that may be disallowed by the tax inspector in a tax audit, because they challenge that the expense is not matching with the revenue. Actually, according to the law, the concept is very general. The current corporate tax regulation do not provide clear guidance on what case and how to justify the expense not matching with the revenue, either by the nature of the expense or either by the timing. Right? So in practice, tax authority apply this concept in many different ways. Recently, they challenge that when you make payment for the service company for transfer pricing documentation, and if the payment made in 1 year, but the documentation document is relevant to another tax year, then the expense is not deductible. This is very new, and then people may be very surprised about this treatment, because normally you do not prepare the transfer pricing document in the year that the transaction happened. You may do some years later. Similarly, some transaction which is not be charged to the cost of goods sold or the production cost, which is general, like general expense or administration expense, consulting, business consulting, something like that. And then you may incur the expense in different year. Even that may be, when working on that, that may be relating to the financial information or financial figures of a very specific year, and that is a potential challenge that tax authority may apply. Another example for that is unused land. In practice, in a tax audit, tax auditor may check whether you have a piece of land is still not in use, or the company has reserved this land for future investment. And then the payment of the land, even the company fully paid for the land rental for the whole project life, or they pay that annually, and tax authorities decide that, oh, this is not matching with the revenue. So this the very sensitive, and importantly, it's not clear. That may apply to many other accrual items that you need to be careful. We now move on to another section of corporate tax of incentive. In practice, recently there's 3 key issues for incentive application. The first issue is relating to determination of incentive package. As you know, that tax authorities, they normally review how the company determine the incentive package for them, and the company is required to self-assess and self-apply the incentive package. But the problem is the law is very not clear on how to distinguish expansion investment project with a new investment project, or sometimes you just additionally purchase the asset for the production only. So sometimes the determination of new project or expansion project also depends on the licensing document and the way you justify whether the new project is independent or not. So quite sensitive and the subject to your justification. So tax authorities, they know this, and when they redetermine the package, they also recalculate the allocation of taxable income for tax collection. So you need to review this area to the company whether the selection of package is correct or not. Another issue for incentive recently happened is that when you have a new investment project, but the project have fixed assets acquired from another project, tax authorities, they may challenge that the new project or the new asset may not qualify for incentive. The reason behind this treatment is that according to the current regulation, if a project inherits assets or location from another project, incentive should not apply. But this is not always the case in practice. It is not fair if in practice the new project is totally independent, totally new. I mean, the investors, they don't know each other, it's very different. And even the project also very independent. It's not mentioned about sometimes it's a restructuring and then the new project is very independent. So in this case, it's very recommendable that you talk to the authority IQ, and then it's not fair that the new project is not subject to incentive. Another issue relating to incentive is that for manufacturing companies, when you outsource the production to another company, tax authority will challenge that the income from the outsourcing business is not subject to incentive. So far, this could be acceptable if the company outsourced 100% of the production to another people. But in practice, it not really happens that way all the time. Sometimes the company only outsources a small part of the production or one stage or one process, and they still keep the key process or main process with them. So the question is how to apply tax incentive in this case, and how to calculate taxable income subject to incentive in this case. And then this issue is not yet solved in practice. So if you are in this case, we're happy to discuss, or you can discuss with the tax authority and so consultant about this to manage the risk in future. We now would like to move on to another very specific issue of offshore indirect transfer relating to capital assignment tax. So as you know that offshore indirect transfer is a transfer between two overseas companies. And recently, tax authorities confirmed that the transaction will be subject to capital assignment tax in Vietnam. But the point I want to share with you today is that so far the regulation have not been updated, or there's not been any further clearer guidance in this area. People still struggle when they consider the issue for the key issue, how to calculate taxable income and cost base in this case, and also for the tax filing procedure, who should be the one to declare capital assignment tax, because later on there should be a conflict between the people who declare capital assignment tax and the one who apply double tax treaties and the one who deal with the tax authority later on. So technically, the one who declare tax is the one who earns the income, receives the income. But in practice, because this is an offshore transaction, tax authority would rely on the Vietnamese company where the capital is invested. So that caused the problem of tax administration later on, especially for double tax treaty. And then the big question for the investor now is that whether double tax treaty in this case can be applied, and if tax treaty can be applied, what kind of treaty, what country the tax treaty should apply. So the question still open in practice, and then you need to follow up if you have some business plan for the transaction, similar transaction. Okay, for now we would like to move on to another areas of VAT. The first issue, practical issue we would like to share with you is VAT treatment on export service. The first thing I want to say is that there has not been any change in the current regulation about this topic. Even the topic is very hot in practice. Many people are still waiting for the confirmation from the authority, especially after the authority issue a ruling for Nike's case. And people may think that if you do a similar activity like Nike's case, they may qualify for export service. But this is not really happen like that in practice. So the key point I want to share with you is that in practice, tax authorities still review the case, consider the case on a case-by-case basis. So they will look into the case with careful treatment. And then the local authorities, in most of the case, they still apply the approach of the collect tax first, and they do not approve for the export treatment, VAT 0% treatment. Another issue is relating to LC services. I don't think this have a big impact to many companies because it's very limited to banking sector. But the way we show this issue is that we would like to indicate to you that tax authority may from time to time look at a specific issue, look at the nature of transaction, and then redetermine the tax treatment. For example, in this case, previously, LC is treated as a part of credit activity and exempt from VAT. But recently, they challenged that LC should be treated as a payment service and therefore subject to VAT. And of course, banking sector, they may not be happy about this because in some case, LC still relating to credit activity and they are debating. And at this stage, I want to share with you that the debate still continue and we still wait for the final conclusion. Again, the next issue for VAT is relating to VAT refund. And then you know that in practice, VAT refund is very sensitive. And tax authorities, they will normally take careful approach about this. Recently, the tax authority apply very inconsistent approach when they review VAT refund for investment project. The problem caused by the confusing wording under the current regulation, because as you know that in the current regulation, somewhere it refers to the new investment project, and in other areas that refer to just investment project. So this can be understandable that if the authorities they refer to the concept of new investment project, they may not accept VAT refund for expansion investment project. But if they just refer to investment project only, they may accept VAT refund for investment project. And then recently, all the authority, including Ministry of Finance, Ministry of Planning Investment, and also the Government Office, discussed about this, and then they agree that for all kind of investment project, VAT refund should be applicable. However, after talking with the Government Office and the higher authority like that, the GDT issued an official letter 5559 to local tax authority with the guidance in this issue. But unfortunately, the guidance in this official letter is not clear. Instead, official letter 5559 still requests authority to check carefully the condition for VAT refund. So that in practice, authorities they focus more on the condition, as in not condition under the VAT law, the condition for other laws also. I can give you example that the Binh authorities they refer to the law on construction and challenge that because the company have not obtained the construction permit and then VAT refund is not applicable. Another issue relating to VAT refund is for export processing enterprises. You may be aware that export processing enterprise EPE is not subject to VAT because they are expected to export 100% to overseas market. But recently, because of change in the regulation for EPE, the EPE status will not automatically apply after they obtain the investment license. The EPE status only confirmed when the custom authority review and confirms that the company qualifies for EPE status. The problem is that in practice, the procedure for the custom authority to review and confirm is not clear. Sometimes it takes very long time for them to confirm. But in that period, the company still have to pay for many types of business, especially for business setting up or land rental payment, for example. And without confirmation of EPE status, the suppliers, the vendors still have to charge VAT. And the problem now happens that the company cannot claim VAT refund later on, because surely later on the tax authority confirms that because you are EPE, you cannot claim VAT refund. This is really the dilemma for EPE investor now. Okay, so now we move on to another area of withholding tax, foreign contractor withholding tax. The potential issue and practical issue I would like to share with you relating to cost reimbursement between the subsidiaries in Vietnam and the parent and the subsidiary overseas or affiliated company overseas. The problem happened because so far many people still simply think that if we should reimburse purely the cost with a markup, FCT would not apply. But recently, tax authorities look more into the nature. And then if the reimbursement, the transaction have a service nature, they may challenge the reimbursement subject to withholding tax, foreign contractor withholding tax. The reason behind lies is, for example, for employment cost, if the local company have the responsibility for the employment cost, and then the head office make payment on behalf, and the company now reimburse to them, so that's fine. Because it's in this case, tax authority can agree that it's a cost reimbursement. But in a case that the head office is the one who is responsible for the employment cost, the employees still belong to the head office, and they just come here for the short period. I mean, all the cost obligation belong to the parent company, and then in this case, the reimbursement is subject to FCT because tax authority applies treatment that the parent company is providing labor services. That's one example. For other reimbursement, for other kind of costs like business management or the recharge of the travel costs or hotel for management people, again, the tax authority, they also look into the nature, whether the fact that the reimbursement have service in nature or not. So in some case, when the head office incurs some management expense from others overseas supplier and then recharge to the local company here. So tax authorities say that in this case, just indirect charge, head office incur first and then recharge to you. Similar to the case that you incur directly, you sign contract directly with the overseas supplier. So in this case, even the head office pay and recharge, we would apply FCT, similar to the case that you engage directly with the overseas supplier and so on. So for reimbursement of cost to parent company or affiliate company, if you think simply that pure cost reimbursement is not subject to FCT, you need to be careful about this, and then because FCT may apply. So I think I have finished my presentation relating to key important practical tax issue that I hope that is very helpful for you to understand and check whether that can be applied to your case. And then if this is the case, that we're happy to discuss further in private. And we hope to enjoy my presentation and have a nice day.